Welcome to tonight's live stream where we are going to discuss the potential impacts of the one big beautiful bill that was recently passed on the stock market, and of course what that means potentially for your portfolio in retirement. So with me as always we have Charles Scavone and we have Chris Paris. Guys, welcome to tonight's live stream. Glad to have you back. We missed you last month. We had the advisors on here and we were discussing the planning components for your individual retirement. So I'm sure you guys missed being on the live stream.
It was tough, but we made it. It'll be okay. We'll make up for it today.
Okay.
Yeah, not a lot of help on the planning side with the bill.
you don't want Chris and I involved on that too detailed a level.
And so that is one of the things that I think maybe sometimes clients don't fully understand. But a lot of times people who are new to Oak Harvest don't quite understand how we compartmentalize different roles and responsibilities here at the firm. So you guys, 30 plus years in the investment industry, chart of CFA, we have other, analysts on the team. But that's what you guys do. You guys do the investment side for our clients, and our financial advisors, they don't touch investment portfolios, but our advisors do the planning. And I know we've talked about this over the years where, quite honestly, most financial advisors probably shouldn't be doing much with investments because that's one discipline and then planning is another discipline. And then if you're in my position where you're the CEO of a company, you have operations, you have marketing, you have all these different aspects. And, it's good to have guys like you that can handle the investment side.
Thanks. Yeah, my belief has always been if you have one person trying to do too many things, they can't do any of those really well. You kind of get mediocre for everything. But if you specialize in what you do, then you can leverage that and try and create the best opportunity to do very, very well in your specific discipline.
So, okay, a couple of house cleaning items before we get started here. We are going to be doing 2 raffles tonight. So you should see on your screen a QR code to register for the One Big Beautiful Tax Guide. So this tax guide helps you understand how this legislation can benefit you in your personal retirement planning. So it goes through the senior bonus deduction. It goes through the increase to the SALT cap and how all of that applies to your personal retirement. So if you register for that, you're gonna have the opportunity to win a $100 gift card to your favorite restaurant. So we're gonna do 2 of those tonight. The first one will be in about 20 minutes and the second one will be at the end of the show. The first one will probably be in about 25 minutes or so, but and then one more at the end. So with that said, we want this to be interactive. So guys, put questions that you have, either that you brought to tonight's live stream, or as we're going through and having these conversations, something that comes to mind, please type it in there. We're going to try to make this as interactive as possible. We do have some core components that we want to make sure we cover. But in addition to that, we want to answer your questions. So really looking forward to tonight. And Chris, I'm going to start with you. So one of the big provisions of the One Big Beautiful Bill was the permanence of the corporate tax rate at 21%. And just to kind of recap here, prior to the Tax Cuts and Jobs Act of 2017, the corporate tax rate was 35%. So that brought it down to 21%. But we had some uncertainty because you don't know, 1, who's going to win the election, and then 2, what happens when that takes place, the election. So we have some clarity. It is permanent, and I say permanent because anything in the tax code is only permanent until a new administration comes in. But why is this important for businesses to know the corporate tax rate is at 21% and staying at 21% for at least the next 4 years?
Thanks, Troy. I think the common theme to answer this question and a lot of the other topics we talk about is its effect on earnings. And if as a shareholder you want more money in companies' hands so they can actually reinvest it or give it back to you in the form of dividends. So, had the tax rate been bumped back up to the low 30s or whatever, that would have been a hit to earnings and could have been a hit to people's dividends, companies' cash flow. So we like that it's going to stay at 21. It's not quite as big of a deal as I think a lot of people think, largely because so much of the earnings on the S&P 500 now are driven by a lot of the tech stocks, and a lot of those companies have a lot of business overseas, and they're not paying 21% right now anyway. They're paying much under 21%. So it's positive, right? On the good, bad, it's good. But it's not this, okay, Katie barred the door, earnings on the S&P 500 are going to go up an extra 10% because of it. They definitely are probably a little low, because I think people had initially penciled in higher tax rates for 2026. That's not going to happen. So the bias from the tax provision by itself biases earnings for 2026 a little higher than people are expecting.
I think if he takes just a slightly different cut of that and say, if that tax provision was not made permanent and you would have reverted back to a 35% corporate tax rate, then the hit to S&P 500 earnings would have been about $20 to $25. Okay, and so if you assign a 20 PE multiple to that, you can take a 500 point S&P point hit, and that's about 9% downside. So by what we did was avert something potentially bad, and that certainly, to Chris's point, not all of that was factored into the upside, but it created certainly a negative event from happening.
Yeah, and to your point, we have international tax treaties with various countries, so we may pay tax on certain profits for these multinational corporations overseas, and then based on those individual treaties, how those profits are treated when they come back to America obviously would have had a tremendously different impact based on which countries we were doing business in. All that is uncertainty. So I think the one thing that we can say is there is far more certainty in the market. And if you followed our live streams for a long time, you know one thing, that markets love certainty. And Charles, to simplify what you said from a valuation standpoint, I guess some of the, let's call them tax analysts who looked at the repercussions of the 21% rate maybe going back up to 35, it all kind of equated to maybe an extra, what did you say, $20 hit?
$20 to $25 in S&P earnings.
So the S&P 500, it has a certain earnings when everything's kind of aggregated, and then if you take that multiple, the price to earnings multiple off those earnings, you get a valuation for the S&P 500. So the after-tax earnings, which is really what matters, would have impacted by about $20 on the aggregate. So if you take a standard 20 multiple,
Right.
You're looking at 400, a 25 multiple, 500. So you're looking at, what was the math, about a 10%?
About a 9 or 10%.
9 or 10% drop.
Downside, yeah. So you averted that, certainly.
So the big thing here, the big takeaway is with the permanence, again, in air quotes, because a new administration could come in, pass a new legislation, change that corporate tax rate, has created some certainty for businesses, which allow them to to deploy their capital in a way that they can more accurately determine and analyze the impact of that project's ROI and whether they should take it on or not. And this all contributes to the bottom line earnings, and that's what drives markets higher over time is earnings growth. So that's in place. We now know what the corporate tax rate for sure will be for the next 4 years, and that leads to some stability in the overall marketplace.
For sure. I think before the election and before the Big Beautiful Bill was passed, I think a lot of analysts had flat earnings because of projections for 2026 because of this tax provision potentially going back up. And now, of course, they've had to pencil them in as anywhere between 7 and 9% higher just because of the tax provision staying put. So on the good, bad, it's a good thing.
Okay. So a few people here. So Dwayne, how you doing, Dwayne? Dwayne Westner from Tennessee. Patrick, how are you? We have Mountain Man, Les in Houston, Texas. I love it, Mountain Man. Scott Paul. And I think we saw Fast Eddie earlier. So guys, everyone, and I can barely reach the computer here, so I may be a little bit slower tonight at getting to some of your comments. I'll probably pull it back closer to me in a minute so we can look at some of the questions while these guys are talking. But again, we thank you all for tuning in tonight and transitioning from the corporate tax rate to the bonus depreciation or accelerated depreciation. Charles, I'll come over here to you first for this one. So first off, what is bonus depreciation, this 100% bonus depreciation? What is it, and how does that impact corporate profitability?
Sure. Well, and I want to go back one thing, what we were talking about previously. We talked about specifically about stocks. One of the things that the bill does in its projections would slightly raise the deficit. And that generally at the margin is kind of bad for bonds. So let's don't forget our friends in the bond market, right? So it's created a good deal of uncertainty in the bond market. So I wouldn't want to lose sight of that. And so we need to keep that in mind. But then to your point specifically, companies have to make capital allocation decisions for large projects, any big capital expenditures, and you want to be able to put them in a position where they can, measure what their expected return is on that investment, right? Because that all flows into overall corporate profitability. And if you can create a situation, as has been done in this bill, that allows a company to accelerate the depreciation of that cost, that large capital expenditure, that improves their tax position better. So it reduces the amount of taxes that they will have to pay. So it improves the profitability, improves the potential ROI of some of these projects, and provides incentive for these companies to make these large investments. And then further within here is the idea of bringing them into the U.S., making those investments here, and providing support for these, investing in the U.S.
Yeah, and that's really, I think, a large impetus behind this provision of the tax bill was to encourage domestic manufacturing and these companies to be able to compete with the lower tax rates that we have in many countries across the world, that these companies can choose whether they want to invest there or here. But it also increases cash flow, right? You brought up a lot of key points there. The increase in earnings, the increase on return on invested capital, but it ultimately it improves cash flow, because when you said it kind of the backdoor way that they pay less tax, but that creates more cash for them to invest in more projects.
Sure.
And if they successfully deploy that capital in projects that earns higher and higher return on that invested capital, then that should accelerate the stock price further in the short term and also
in the long term as well. Yeah, it creates that flywheel effect that we talk about a lot. The other thing it does is it gives the CFO a few more levers in terms of, again, capital allocation. They could return some of that to shareholders in the form of dividends, not a bad thing, or increase their share repurchases, as well as having additional capital for higher return projects.
So that's a kind of interesting dynamic, because the CFOs of these major corporations, they have to decide the capital allocation strategy. So that changes at a fundamental level within these companies when they have different policy, they have certainty. Now, we could argue there's some uncertainty with tariffs depending on what industry that you're in, if you're a service business or a manufacturer or you're importing or whatnot. But ultimately, these CFOs, when they allocate capital, they can either return dividends to shareholders, they can invest in various projects, they can expand human capital by hiring different people. And of course, it's not just one person making these decisions, but I know ultimately if our taxes are lowered as a company, when I have to decide how we allocate capital across marketing and employment and projects and things like this that we do here, we have to methodically go through the pros and cons of all these different decisions and then allocate that additional capital intelligently so that it improves our business. No different for, these multinational corporations. The only difference is all of that is publicly available as far as the results of those decisions, and then that flows through to the bottom line, and that impacts the stock price. And that's what, on the investment side, we're ultimately trying to get ahead of, at least understand what are these projects, what are these decisions that they're making, how is that going to impact the bottom line in the stock price?
Yeah, Troy, as much as everyone in the public stock markets talks about long-term investing and trying to incent managers to think long-term, at the end of the day, they still get a quarterly report card. So the incentive for a CFO or a chairman to spend a lot of money, they usually smooth it out over a time period. So they try to smooth out their risk. It might take them 3 years or 5 years to have a new manufacturing plant with the lines and everything else. This allows them to accelerate all that right off the depreciation up front. And and actually take a little more risk up front, so that hopefully the reward to the shareholder and the corporation comes sooner because they made the investment. They'll have capacity to generate revenue, hopefully earlier rather than later. So, it's on the good, bad, it's good, once again, for most stocks in the stock market that are where the companies are spending on property, plant, and equipment.
Yeah. So again, let me try to explain this, because when we talk in fancy words like depreciation and some of the other finance terms that we're using, we understand that you're not a finance expert and some of these terms may be new to you. But think about it this way. So let's say you're a company and you want to invest in a manufacturing plant or some type of, you want to buy something that's a capital asset. And let's say it costs you $1 million. Under the old tax code, now there have been some changes over the past few years, and there was some phasing in and now phasing out, I guess, of some of these discounts. But for simplicity's sakes, if you want to invest $1 million into a capital asset, instead of that $1 million offsetting your income in that very first year, you had to take that $1 million and break it up. So only portions of it over a very, very, very long period of time, many, many, many years. So let's say $10,000 a year or $25,000 a year. So your net income was not, it didn't benefit on paper from that decision because the deduction had to be spread out over very, very, very long periods of time. So what this does, the bonus depreciation component of the tax law, is if you spend $1 million today on a plant or a capital asset or some type of, let's call it manufacturing facility, you can immediately deduct your earnings by that $1 million expense all in this 1 year, as opposed to having to stretch that out over many, many, many years. So what that does is that increases your net income, or in terms of stock market, your earnings per share, because you have more net income. And when you divide all that net income by the outstanding shares, you have a higher EPS, or earnings per share. So Charles, that's the simple version of it, but that's why some of these things impact the stock market and impact your portfolio. And we're going to get into some of the sectors that may benefit more from this and some that may not. But in its most basic sense, that's what bonus depreciation does for companies that have publicly traded public equity.
Sure. And then our job becomes find those company managements who are operate in industries and put in place moats that we talk about that helps protect their franchise and can deliver the highest returns on that newfound extra cash flow and earnings.
Okay, so so we really have three big components here of the new tax bill that impact the stock market directly. And then we're going to talk about some of the sectors. We're going to talk a little bit about what the Federal Reserve is doing with interest rates. And we're going to tie all this back to what the market, how it could impact the market over the next 2, 3, 4 months, and what we're thinking as we make capital allocation decisions inside our client portfolios. But the third one is the R&D expensing. So Chris, research and development, expensing, why is this important? Which sectors benefit from this? And what does it mean for the overall market?
I mean, on the good, bad, it's good once again for any industries that have large R&D. A lot of technology companies, a lot of software companies, a lot of healthcare companies, drug companies have large R&D budgets. And I mean, these projects that they're doing R&D on last 5, 10, 20 years, and it's kind of like accelerated depreciation as well. They get to write those things off sooner rather than later, and hopefully it incents them to take on projects now, as opposed to deferring them and waiting till the sky is all clear, until everyone is happy and they're smooth sailing. So these are both incentives to try to get investment here in the United States jump-started more than it's been the last 5 or 10 years. And they're trying to do it from a tax perspective more than this is not regulatory, which is another area we have talked about. They're trying to reduce friction, and these are areas in a company's income statement that are lower friction.
And so the government only has technically a few levers that they can pull to influence behavior. And the tax code is one of those levers that they can utilize to influence behavior. And I think we see that quite extensively in this bill in regards to its pro-business agenda. A lot of these big components, the lower corporate tax rate, or at least the permanence of the lower corporate tax rate, the bonus depreciation, the R&D expense, the ability to deduct that immediately. All of this is designed to create economic activity domestically in this country. And we're not going to talk about it tonight, but there's an international law, international tax component to this bill that actually increase taxes for certain international income. So this bill really is all about, like most tax policy, honestly, but this one particularly, I can't remember any changes in my life that have been really more impactful for the corporate tax landscape to incentivize behavior, productivity, manufacturing, activity here domestically in the United States of America.
The other thing it does too is what has made our economy and our market-based economy so great is that companies have the opportunity to take advantage of the conditions in which they're given to develop new and innovative products. Okay, in a lot of countries, a lot of the basic research and development, new technologies that are developed or medicine, whatever, is done at the government level. And so what this is doing as well is shifting that more. And our government has done historically a lot of basic research, but the best research has always come from companies, the great companies that are here. And so this provides a greater incentive for them to sort of re-engage in that sort of activity, shift some of that burden from the government to these corporates, which are probably better stewards of capital in terms of generating returns because the incentive is so much greater.
Yeah, absolutely. So we have the raffle coming up in, let's say, about 5 minutes here. So you have an opportunity to register for this raffle. We're going to give away a $100 gift card to your favorite restaurant. And in order to register for the raffle, there's a QR code that'll pop up on your screen. You're going to register to receive the One Big Beautiful tax bill guide to your personal retirement. How does the senior deduction work? How does the SALT cap increase potentially impact your retirement? So by registering and receiving that guide, you have the opportunity to win a $100 gift card to your favorite restaurant. We're going to do it in about 5 minutes, and then we're also going to do one at the end of tonight's show as well. So Corinne, can we get a poll up? I want to see how everyone feels about the new set that we have and the new kind of setup here. So many of you have followed us for some time, and you maybe you noticed, maybe you did not. Over the past 2 or 3 live streams, we've been tinkering with the setup here. And so we're going to put a poll up. I want to get your opinions if you like the setup, if maybe you want to see some changes, or, hey, you want to go back to how we used to do it if you tuned in back then. So just curious what you guys think there. Okay, so want to transition one quick topic before we get into the raffle, and then transition to maybe what the Federal Reserve is doing and some more of what sectors may benefit from this bill. So which sectors, Charles, when we talk about the ability to accelerate depreciation, which sectors could potentially benefit more from a provision like that in the tax bill?
Sure. Well, we think about it. Anyone who has large capital expenditures, but what came to my mind most quickly is within technology, right? It's all about AI, development of artificial intelligence, and these large data centers. These are very capital-intensive projects. So big beneficiary would be companies within communication services, the big cloud service providers.
See, Meta is putting in a $10 billion facility. They have for some time now, but I think they're close to finishing it. I was just reading, I think it's in Louisiana.
I think it's in Shreveport.
Shreveport? Yeah. I was just reading how people in Shreveport are just in awe of this $10 billion data center.
They've done these things very quickly and very efficiently, and it creates this whole food chain effect, right? We talked about it before. We like to look at things in terms of the food chain. So it's not just, not just a benefit for, Digital Realty Trust or whoever, if it's ultimately owned by a REIT, but there's a whole supply chain of companies who provide the equipment into these sort of facilities, and then the employment base. And you even just think, restaurants and retailers and all in that particular region of the country, because it spurs employment growth there.
Employment growth, economic activity, it trickles down, so there's more money in more people's pockets.
Yeah.
There is this entire
Yeah, even to the energy providers, things you might not necessarily think of. These projects are huge consumers of electricity and the like. So you even need to start thinking outside of the box a little bit, alternative sources of energy, or how do you reinforce and upgrade the power grid? And so there's this huge multiplier effect, is what it's referred to, as what you talked about. That it increases the overall level of economic activity.
And so the Meta's $10 billion facility in Shreveport is actually a really, really good example, because I'm sure they started that prior to the passage of the bill. So I would imagine, I'm not an accountant, but I would imagine part of that investment is going to have to be depreciated over decades. So they're not going to be able to probably take all of that and use it to offset earnings in this year. But I think, from my understanding of the bill, and if you're a tax accountant and you have any expertise in this area, feel free to chime in. But I believe it only takes place for, I don't know if it's entire projects or money spent for maybe previously commenced projects. But there's an early, I want to say January 18th, 2025 cutoff date. So I guess it brings up an interesting point, as maybe a portion of that facility could be depreciated, some of it may not. Point being, Meta's earnings, if they would have started that entire project this year, that's $10 billion they would have been able to use to offset earnings, which would have reduced taxes on $10 billion of income. And on a very simple calculation, at 21%, that's $210 million in additional money they would have in their pocket for them to then choose to deploy that capital how they choose. And knowing what Meta's done over the past few years, stock's done pretty well. They probably would have deployed it in a way that advanced their business in the way they best see fit. Whether that happened or not, time would tell. But that's a lot more cash to deploy to improve your operations and increase your earnings per share, and therefore the stock price potentially over time.
Sure, and the signals that we're seeing or getting from companies is that a number of these projects, these companies have such incredibly strong cash flow already that these projects are in the queue, because to your point, you're right, they're planned out in advance, and it requires a good deal of advanced planning. So now all you've done is sort of accelerated the ability and the profitability and the cash flow dynamics of all these future projects. And then what do you do as a steward of that excess capital? We talked about it just a minute ago. Dividends, share repurchases, there's a whole litany. And as growth investors, we're always paying for this expected future stream of cash flows and earnings. And so it looks really enticing for growth investors.
One thing you can be certain of is projects that they've planned for maybe 2029, 2030, 2031, 32, they have probably accelerated to the greatest extent possible into Trump's term, because you don't know what's going to happen to this bonus depreciation.
Yeah.
So they've probably screened the timelines. Okay, so we're going to do the raffle winner, and then after that, we're going to hop into an industry that's going to benefit from bonus depreciation, but still may not be an industry you want to invest in. So we have Mark Corneglio. Mark, you are a winner. I hope I pronounced that correctly. Mark Corneglio. So you are the winner of tonight's first raffle. Congratulations. Our marketing department will reach out to you and connect with you to get you that gift card for your favorite restaurant. So for those of you who did not win, as previously mentioned, we're going to do one more of these raffles at the end of tonight's live stream, where you have an opportunity to win a $100 gift card to your favorite restaurant. Okay, Chris. So airlines. Airlines are a company or an industry that
even Warren Buffett lost money in.
Yes. And I guess airlines are not the industry, but okay. So airlines is an example of companies that are going to benefit most likely from this increased depreciation. But why should everyone understand that just because you're a company in an industry that may benefit tremendously from this provision of the tax bill, maybe, we're skipping over as far as consideration for investment merit?
Yeah. good example because we probably won't be investing in airlines because they're here in the United States. They're not growth industries. They're cyclical industries. They do have their 6 to 9 month window generally where the stocks can work. So long as energy prices are down, there are no labor strikes, and the economy is good. If all those three things line up, the stocks can work. But there's so much competition, there's so little differentiation. We would generally stay away from that area probably in the fund and in our models. However, if those airlines are out there ordering planes, there's only really two plane manufacturers in the world, Boeing and Airbus. So we would look towards the growth areas, the suppliers to the airlines, so we'd look in that direction, or even the suppliers to the Boeings and the Airbuses. So we'd look down the food chain.
So, what a tremendous segue, Charles, into the supply chain, the pick and axe, our
old pal Levi Strauss.
Yeah, our old pal Levi Strauss here, because we had a lot of crypto questions that came in pre-submitted, and we also had a lot of financial planning questions. So this is a good opportunity to let you know. Last month, we did a tremendous live stream where we had all of the planners up here. Well, not all. We had, I think, 3 of us. And we discussed in great detail how the One Big Beautiful Bill impacts your retirement from a financial planning side. And I believe we may even talked a little bit about crypto there. We'll talk maybe a little bit about it right now. But if you didn't tune into last month's live stream, we went into great detail. I think we had a tremendous turnout. Eric, what do we have? I think 1,000, 1,500 people within the first 24 hours. It was, really, really good, impactful live stream. So I've asked Corinne to prepare the link. She's going to put that in the comment box or the description. So if you want to understand more about the personal retirement planning side of this bill, the SALT cap, the senior deduction, and some of the other big components, feel free, bookmark that. If you want, leave us now, go watch that if it's more important to you. But a really, really, really good video. We had a great discussion, so that's there for you. So Charles, tell us the crypto story, the kind of segueing off what Chris mentioned in regards to Boeing and the supply chain, and how you don't have to necessarily take excessive risk to benefit from either trends in certain asset classes or industries, where you can kind of play it maybe, I don't want to say the smarter way, but definitely, let's say, the less volatile and less risky way.
That's a good way to frame it up. Yeah, so if you've watched and listened to us much at all, you know that we're very much growth investors. We love to put pencil to paper and find companies that are generating sales, margins, and return on invested capital. That's our mantra. We certainly understand what cryptocurrencies are, what they do, and how they use. But at the end of the day, they don't make in my view, a good direct investment choice for us because they are not a productive asset. They don't generate sales, margins, and return on invested capital. Your expectation in directly owning a cryptocurrency is what I refer to as the greater fool theory, and that is somebody else is going to come behind you and buy more. And that works just fine until it doesn't. Our perspective is that there's an easier way, and we jokingly refer to it as the Levi Strauss method, and where our old friend Levi Strauss back in the minor 49 or the gold rush days in San Francisco and in California, he made his fortune selling picks, shovels, and jeans and overalls to those hardy fools who rushed in to pan for gold and risk life, limb, and good health by being on the bleeding edge of things, if you will. And old Levi, at the end of the day, he slept in his nice warm bed in his home in San Francisco. For us, we take the same perspective and say it makes a lot more sense for us to invest in tangential companies and industries that support the growth and proliferation of cryptocurrencies. And for us, that's folks like Charles Schwab, who makes money every time you engage in trading in an ETF or the actual crypto, whatever sort of security they fashion for you to trade. And the people who manufacture those products are the BlackRocks of the world. And then, the trading in cryptocurrencies is now there's futures markets. And so companies like CME provide the platform that allow investors or traders to trade those. And these are immensely profitable companies that make a lot of money off of cryptocurrencies. Yet Chris and I, can put pencil to paper and see what's going on and come up with what our forecast is for sales, margins, and return on invested capital. And we've done really well in these names. The most interesting thing that nobody's talking about right now are the potential implications for cryptocurrencies and, the value of the particular coin is based upon this hash rate and your ability to use computing power to get more of them. And what's interesting and what's on the come that nobody's thinking about currently is that if there is success in quantum computing, where we're seeing a lot of success, then the first guy that comes along with a quantum computer that takes hash rates and slashes them because his computer does computational skills 1,000 times faster than the current whatever NVIDIA or AMD processors being used, cryptocurrency is going to drop like a stone.
Would the currency drop like a stone itself, or would it be more adopted because the transaction rates are faster?
The value of it gets dropped because the supply of it just went up by that much because somebody figured out the right switch to flip on his quantum computer.
So I know
this is
way
for
off. Example, it's a finite quantity, so you cannot produce any more past that finite quantity. But there's a lot of them out there you can mine, I would imagine, and those would be probably more at risk.
Yep.
So it really is an interesting take on the impact of one of the most exciting and developing technologies out there, the quantum computing, and that has applications across the entire economy. And like, if you think AI, and it has made a tremendous difference in the way we go about our everyday lives and the way businesses are, analyzing data and making decisions. When you start to look at the research and development, you start to look at cancer, curing cancer and these different things. When you can multiply the rate of that data analysis by thousands and thousands, you just accelerate growth.
A whole new
It's a whole new world.
Phase. Yeah, Chris and I Chris saw today, IBM. I mean, and this is really being picked up by a lot of big companies. IBM, I forget who they're partnering.
We're partnering with AMD.
Yeah, to work on this, and within Honeywell is one of the largest quantum computing companies, and they and a private equity firm own one of the bigger ones, and that's going to come out later this year. It'll get spun out, and that'll be an interesting IPO.
So you and I talked a couple of weeks ago, and I just was checking in with you. I was like, how's some of the research, the conference calls going with the quantum computing companies? We don't want to get into any particular names because we don't want to give you investment advice when we don't know your particular situation. But just in general, you were on a bunch of conference calls listening to the CEOs of these quantum computing companies. What was the big takeaway for you?
They are bulking up on incredibly bright group of highly specialized academic researchers, partnering with large companies like Honeywell, IBM, some of these private equity firms. They're taking a handful of different approaches. Some of them are more semiconductor-like, some of them are more integrated systems-like, some of them are even a little bit software-like. So they're approaching it from different directions. The biggest challenge is error rates. Without going into a lot of detail, it doesn't matter if you can compute something 1,000 times faster if the answer you're getting is wrong. Right? So that is the challenge, and the current expectation is that within the next 4 years that there will be commercially available and more widely used versions of this type of technology to use.
Well, that's exciting because, as growth investors here at Oak Harvest Financial Group, these are things that we're focusing on for your portfolio and for what we're doing in our growth strategies. So really excited to continue to hear about these because they do have the ability to transform every aspect of life. Now, are they all going to succeed? No, they're probably not.
Nope.
But, you think back to NVIDIA, Chris. I mean, what was NVIDIA doing in 1998, 1999, 2001?
Graphics processors for PCs and gaming.
Yeah, and then you see the acceleration. One of the things I read today, NVIDIA did a really, really good job partnering with research educational universities and their research departments to really accelerate not just the practical use of their chips. I think the University of Florida was the first one like 5 years ago to get the Blackwell chip. But then I think a sharing of that data back and forth and it really helped them adapt and grow and then become, the company that we know today.
Yeah, the Trojan horse of NVIDIA is a bunch of software they have that a lot of researchers use and designers use, and they've been using it for years. And I think it's CUDA. Isn't it?
CUDA,
CUDA is the software
that's
package.
Right.
So,
it's a whole. That's their library, what they refer to their software library.
Yeah, I think they started that at the University of Florida, I believe, is what I read today. Yeah,
along with Gatorade.
As part of the with Gatorade. And it's tough to say that as a Florida State University alumni here, but University of Florida is a great school, and it's that's a large part of kind of what you're talking about as far as a lot of the research and partnering there. Okay, guys. We're going to bring this back to not just the bill itself, but I want to talk about the Federal Reserve, okay? Because we have Jerome Powell, who is still fairly obstinate in the face of certain economic data. Look, President Trump probably should not be calling him out like he is and threatening the independence of the Fed, but we've said Chris, we were saying back 5-6 years ago that maybe 3-4 years ago that he was too late to raise interest rates to start to curb the effects of the inflation that we saw real time, but they're relying on government data. And it was hilarious recently when Chairman Powell came out. I think I was talking about this with you or maybe you, Chris. He comes out and he talks about the veracity of the data and how they're degree of confidence in the data that they're looking at. The United States has the gold standard of economic data, and then the very next day comes out and we have these massive revisions to employment data, and the employment data is one of the two main drivers to the Fed's interest rate policy decision-making process. So he kind of had some egg on his face there. So, it is what it is. We said for so long he was late. We now think he's late again. It's not a political thing. It's just it's how we feel. The data that we look at is different from the data they look at, which is 3 months old.
It's a data thing, and I think we've referenced a couple pieces written over the last 2 years on the internet that triangulated the real employment data and what the revisions were going to be, and the revisions were exactly that.
800,000?
Lost jobs, never there, were part-time jobs, not full-time jobs.
It's just funny that it happened kind of right around the election.
It is, although what's interesting, so just in his speech last week, Powell, for the first time, talked about, inflation is more of this one-time event caused by tariffs, and we're concerned about the employment market. He had said over the prior month or two during his speeches that it was so strange because he said that he didn't really believe the data, because there was always being revised and stuff. Then he came out that one weekend or whatever that was and said it's the gold standard, and then have an egg on his face the next day. So they are coming around. I'm not of the belief that whether they cut rates in September or November or December, they're going to cut rates, right? And whether it's then or farther on in the year, if they don't cut them in September, does it cause 5% down? Sure, it can, but they're going to cut rates. They're too tight. They've said they're too tight. The good thing is that the stock markets move in advance of all this stuff. The bond markets do too. And, Trump has said that they're going to cut back on the tariff talk come October. I think they start cutting rates, and you get an acceleration in the economy, in the fourth quarter and then in 2026. So whether they're not too late, they're late, but I don't think it's going to cause a big issue with the labor markets so long as they start moving. So, yeah.
Do you think, or don't you think that if there's something that could trigger a recession more quickly, it would certainly be, labor continuing to fall off. Labor, if you have, they always talk about this equal mandate, but it just seems in my mind, I don't know, we've never really had this discussion, but it seems as though that labor number would be a lot more important in terms
especially
of
when you're working off bad data.
Well, if truly, employment is going down that quickly, that to me would be much more alarming than the potential for a modest increase in prices as a result from tariffs.
I 100% agree, because labor are units, right, versus pricing. And if you start stripping out units, 10,000 jobs or 20,000 jobs, it starts to hit very quickly.
You start to have the multiplier effect,
yes,
which then ripples its way through the economy.
Yeah.
But to your point, they're realizing that the labor, the labor is declining way after the fact. Now, look, we still have, the job market is fine in this country. The point being is they're making decisions off data, which then 2-3 months later they're finding out is completely, off.
Yeah.
So if we get to the point to where they're making decisions off data, and then 3 months later it's really off, okay, now we're too late right. to really make any impactful adjustment. We're going to have to eat the medicine, go through it for 6 months, 9, 12, 18 months, because they put the inflation mandate over the labor mandate.
Yeah, and that just seems unacceptable.
But then they're looking at the bad data for inflation numbers too.
Yes.
So what's going on here?
They need to use AI. No, we've started using much more intensively alternative data to help track various aspects of individual companies, and in some respects you can aggregate this all up and into different economic data. And what I mean by alternative data is just simply the fact nobody's got their cell phone out. That phone, that Google Maps, knows where you're at in every place you visit. It knows where every Starbucks is. It knows where every store you go to. All of your credit card transactions are known, and so this data gets
and it's public,
aggregated.
and we say publicly available. You have to pay for it,
right?
This really good data.
Yep.
But can we talk a little bit about some of the things that we're able to look at?
Oh, we look at it. When we look at this data, and it's very detailed, but it doesn't know that it's Chris Paris or Troy Sharpe. It's all aggregated into pools, and then it's referred to as metadata. So it's blinded in that respect. But one of the things that we look at, say in restaurant stocks, is good. For instance, today, we're looking at foot traffic and transaction volume and transaction amount in restaurants by week, and comparing that data to where Wall Street analyst estimates are for companies' earnings. And we aggregate this, or our pal Dwayne does, our colleague does, using Bloomberg and using their quantitative system to aggregate and look at this data and look at it over a 92 period data stream, and looks at all of the data history. Was it accurate? Did it adjust? Was it underestimate? Did it overestimate? And then it adjusts.
You do a statistical analysis.
You do a full statistical analysis to determine the accuracy of it and the validity of it, and we overlay that versus the data that we use on our individual stocks.
Is it crazy that we have more technologically advanced data here than the Federal Reserve?
That's kind of where I'm going. And
think about it. What is the Federal Reserve using? They're using surveys,
right?
Yeah.
That they've used for decades and decades and decades. When you have this more advanced, not just the metadata that's available on every single one of your phones. So if you go to McDonald's, we know about it. We don't know that you personally went to McDonald's, but we're able to see the foot traffic in McDonald's over time run statistical analyses, look for anomalous events, and identify opportunities or warning signs. And the Federal Reserve is relying on surveys. Are these surveys still paper, I wonder? Or have they started to distribute them electronically? But that is what we're dealing with right now, and that is a scary thought. And I know maybe some people may think I'm coming across as a bit, condescending here, but look, I'm in shock. I'm really upset, honestly, because the fate of the free world is based on survey data that they're sending out when we have,
They economists love to break this data into hard data and soft data. So hard data, like unemployment, would be the weekly claims, because somebody is literally walking into a state unemployment office and filing a claim for unemployment. But then they put all kind of crazy adjustments, or then the number will come out and you'll find out that California had a problem with their equipment and didn't report it, and you get this wonky number. And then survey data, if sentiment is bad and you take a survey, is the data going to be generally reflective of what's going on, or is it going to be a little bit? It's going to be a little bit worse.
It's going to be an emotional component to it, right?
Right. So I don't know.
Okay. So point being here is, again, let's tie this back to everyone's portfolio, and then let's get to the final raffle. Then we'll look at some of the questions here. There's actually a really, really good question we had about the Affordable Care Act and the subsidies that I don't think many of you are aware of. So if you're under the age of 65 and you're retired, and this will impact you almost certainly, we're going to cover that. But Chris, any kind of final thoughts on the Federal Reserve? What, I think you made it pretty clear at this point.
Yeah, I mean, whether they cut in September, October, December, they're going to cut rates. They're too tight. Charles, myself, I look at the real-time data in the bond market, right? You can dissect interest rates into real growth and inflation, and inflation's higher than 2%, right? It's 2.75%. I would rather have that in the economy starting to get better, which actually a lot of the data is starting to pick up. Economic surprise index has turned up the highest point in, I think it's like 6 months now. So I'd rather have better growth and a little higher than inflation and worry about that, because as an investor, right, we're talking about it as an investor, not as a consumer, it's better for earnings, it's better for stocks.
Yeah, because 2 to 3% inflation is not bad. The Fed's mandate is 2%, but if we don't have inflation, we have deflation or stagflation, and those are a lot worse than inflation. So we'd rather see it go to 2.6, 2.8. You're talking about on a real basis, right? Not nominal?
The inflation or the real side?
Well, where are we at from a real rate side?
Real rates are like 1.3 right now.
Okay, so but on a nominal side, you're seeing inflation. You said 2.3, 2.4,
2.7,
2.7, somewhere in that range. Point being is we'd rather see a small uptick in inflation because the Fed cut rates, as opposed to risk going into recession because the labor market is deteriorating far more rapidly than they're able to identify with their, let's call them, less than modern methods of calculation and analysis.
Yeah, I mean, I guess more simply, you might hear a ton of panicked people on CNBC and Fox News if interest rates go above 4%, right? Or the 10-year goes above, 4.5%. You're going to start to hear all these people like it's the end of the world. It's not the end of the world so long as it's
We've been there for 2 years.
Correct.
Right.
We've actually been there for almost 10 or something like that outside of when they took them down to 0. But, you want higher real growth. And if inflation stays at 2.5%, 2.75%, and we get higher real growth, and interest rates go up to 5.5% on a 30-year bond or a 10-year bond, the stock market's going to be okay because earnings are going to actually exceed that.
Yeah.
And,
so I mean, if rates are at 5.5 and inflation's at 3, we still have 2.5% real growth.
Correct.
Right, and that's a very stable place to operate from as far as determining what corporate profitability growth will be, and also the decision makers at these large corporations, they're completely fine with that.
They can adjust so long as it's a slow rise to that level.
Now, ancillary effects, obviously, in regards to if you're getting mortgages or if you're, as a on the consumer side, it's a lot different than on the investment side because there are different impacts. Okay, so we do have our raffle winner for tonight. It is Marcelo Barsanti. So, Marcelo, congratulations for winning tonight's second raffle. And our marketing department will be in contact with you to deliver the gift card to your favorite restaurant. So we thank you very, very much for tuning in. Okay, guys, let's Charles, I'm going to throw it to you. Are there any areas regarding the One Big Beautiful Bill and its impact on the markets that we didn't cover tonight and you'd like to cover before I jump into the healthcare side?
I think we covered most of it. I think the only thing I would add to it maybe is that from an investment process standpoint, right? We always said we build our portfolios one stock at a time, but then we always take a step back and take a top-down view of things and make sure that the top-down view is consistent with the bottoms-up portfolio construction. And that's certainly as a result of a fiscal action such as this, it certainly causes us to do it and make sure that the strategies, the stocks that we use in our single stock strategies or within our hedged equity fund are all consistent with what we've talked about tonight.
Can I do a shameless plug before you move over to the
healthcare
side? So,
sure.
Charles and myself are going to do a lunch and learn over in the next month or so here for clients here at the home office. I'm not sure how many seats are available, but I would, if you can, I would sign up for it if you've been invited. The topic's going to be what could go right, because you're always hearing on TV, about the doom side of things. So we're going to try to talk about what could go right in the economy, in the markets, maybe some different sectors in 2026, whether it's quantum computing or robotics or AI, those kind of things that are thematic investing and stuff. So,
yeah, really good. Okay, so first I want to say hello to Paul. Paul, how you doing, man? You're always here. Appreciate everything that Nicole loves you and appreciate it. And thanks for noticing the oak table. So we have oak tables throughout the entire office to play on, Oak Harvest Financial Group. So quite a keen eye that you have there. John Krupa says he wants us to address the tariffs. He calls them idiotic tariffs. Look, I've always said from the beginning that the tariffs are meant, again, to influence behavior. And ultimately, we're a 70% service economy. So, yes, they are creating tremendous disruption in a lot of manufacturing activity within this country and abroad. There's no doubt about that whatsoever. I don't think that's President Trump's intention. I think his intention is to use these tariffs to negotiate trade deals with various countries. So he's using them as a tactic, essentially, to negotiate. And there are people in the manufacturing world that are being hurt. But from a stock market, from an investment standpoint, we are a 70% service-based economy. Most service-based industries are minimally impacted by these tariffs, but it's always good to bring up a very excellent question there, John. Wanted to make sure we pointed that out. David Grant, I saw David. How you doing, man? I saw you had something here. I know you're interested in the healthcare, so I'm going to transition to that right now. The main thing I want to discuss about the healthcare is that there were extensions of the government subsidies for the Affordable Care Act for those of you that are under the age of 65 and retired. This helped to keep your premiums down if your level of income was below a certain level. Those expired at the end of this year, and as part of the new tax legislation, they were not renewed. So there are many of you that are possibly expecting a certain level of health insurance premium if you're on the exchange that will be, I think experts are saying, around maybe 1 to 2, possibly 3 to 400% higher. So this is a significant increase. It may go from $800 to $1,600 or to $2,200. So as part of the Inflation Reduction Act under President Biden and a couple of other, I want to say it was the American Rescue Act possibly, the government has essentially been funding your health insurance premiums if you're on the exchange substantially for many, many, many years. Those were set to expire at the end of this year. They were not renewed at the end or in this new tax bill. So from the personal planning side, and we talked about this in the live stream that we did on the personal retirement planning side last month. So Corinne, if you could put that link up to the previous video again, please. If you're younger than the age of 65 and you are on the exchange and you are expecting lower healthcare costs, your income will need to be substantially lower next year than it was this year, your modified adjusted gross income, to qualify for the same subsidy. So again, this is not necessarily investment related, but this is kind of public, alert related. This is what we do here. This is technically step 4 of our retirement success plan. These are some of the planning steps and strategies that we put in place for our clients. If you're not a client and you want this as part of your overall retirement strategy, of course you can reach out to us. But regardless, please be aware, under the age of 65, if you're retired, if you're on the exchange and you've been receiving some type of subsidy for your health insurance premiums, that dynamic is going to drastically change next year. So talk to your advisor, talk to your healthcare specialist, and if none of them can help you, please reach out to us, because we have a team of people who, this is what we do for a living, and this is how we help our clients. So that's something very important to kind of leave us with here. Looking at any other questions that we may have here before we wrap up tonight's live stream. This is we got some good feedback on this on the setup, so that's good to hear. Well, national debt. Okay, so I want to, John J asked this 30 minutes ago. John, if you're still here, I think it's actually just a good ending note. So John says, even though the market looks nice at 45,000, he's talking about the Dow here, way overpriced, just like housing from the decade plus of low interest rates and COVID financing, loose policy. Overall, what his question is, or his comment is, he's fearful, it seems like, that there are large distortions of real value because of all the government support, all the things that have kind of gotten us to where we are right now. Guys, when we look at actual value versus possible distortions of value, because this would be a real risk for somebody in retirement, right? 2007, 2008, 2006, housing prices, tremendous distortions in value led to a collapse of almost the entire financial industry. That was something that was structurally distorted from a value side. Anything at all out there that you guys see similar to that now or could be a concern?
Not currently, but we're hoping.
Yes. Yeah, I mean, Charles is right. I mean,
well,
he's asking,
hoping in the sense that it creates opportunity, right?
Yeah, I mean,
Chris will answer. Chris will tell you what I'm thinking.
Yeah, I don't know. The questions are: we in a bubble?
I know what you're thinking.
Are we in a bubble? And if so, how do I get out or whatever? And like, my comeback to everyone is, find me the person who said we're going into a bubble and got me long, and I'm riding the bubble, and I'm
until it pops and they got me out.
Yeah, I mean, because yes, national debt's a problem. It's been a problem for 40 years, right? Has it benefited the stock market? Yes. Has it benefited the housing market? Yes. When is when? And I mean, I could triangulate something, but it's not right now yet. You mentioned something on housing in 2007, and I read a piece that every bubble was preceded by deregulation, a large amount of deregulation. Housing bubble, financial bubble. The
tulip bubble?
If we start to get a bunch of deregulation.
There was massive deregulation with the planting of tulips.
Yeah. in our stock market.
Yeah.
Back during the market crash in '29 and stuff like that. I guess there was a lot of deregulation in front of that during the Roaring '20s. So if we start to see a lot of deregulation over the next year and asset prices, go parabolic, because they are not currently parabolic. They're up a lot, but they're not moving in integers of 1, 3, 5, 7 like they were in '99, 2000 when Charles and I were managing money.
Well, I mean, you do have certain, let's call them little letters that are representing an entire industry right now that have gone parabolic. AI.
Well, some of them have. I mean,
Google trades at 18 times earnings.
Yeah.
But
right?
Google's not an AI company. I guess I'm referring, and I'm not saying that there's not tremendous value there, but you do have some parts where there is hyper aggressive, long approach to the entire anything with AI in it. That I'm not saying it is a distortion in value by any means. Just more devil's advocate to there is no parabolic moves.
In the market,
but in certain companies there have been.
Sure.
There always is.
There
of
always
course.
is.
Yeah.
But
there always is. There are always
maybe that's
pockets.
a risk. Maybe there's, but they have earnings, right? This is not 1999 where you have these parabolic moves in companies based solely on revenue growth or the thought of potential revenue growth. You actually have solid margin expansion, revenue growth, and earnings growth. So it's hard to say that's a distortion in value.
Are there things behind the scenes that concern me in AI? Yeah, when you fund your, when someone funds their own supplier to buy stuff from them to expand, I mean, that kind of stuff is concerning. Is it, is it the bubble-licious level yet? No, not yet.
It's not widespread enough.
I don't see it yet widespread. No.
And so to Charles's point earlier, if some of you are thinking here what he was thinking and what I realized there is, so we have a tool that we're allowed to take advantage of distortions in value, or we're able to take advantage of distortions in value and actually bet that there is a distortion in value there, or invest that way. Charles runs that strategy, and if there was some large distortion in value, it would be a tremendous opportunity for you to take advantage of.
Sure. Yeah, we try and create product that allows us to, provide some degree of capital preservation in the event that these situations arise, and create a strategy that allows an investor to get invested and stay invested and not have to worry so much about issues like this. We've seen it before, and I'm hopeful that it presents itself again, because then we'll be in a good position to do well for our clients, and but that's what we're here to do. Simple as that, I guess. To sort of maybe sum of it up, though, is that if the Fed does start cutting rates and deregulation continues to, increase, and we get a big pickup in M&A activity, and we sort of see the IPO market overheat, that'd mean that the stock market is, that the NASDAQ is 35% higher, from here, something like that. And that'd be fine. And the way that we run all of our strategies and the way that our advisors work to make sure they have proper asset allocations, we should be in
feel
good
confident.
shape. Feel confident, yeah.
But that is the confluence of events that would probably take place. It's whatever you read, I'm sure it was more than one thing. It's a combination of factors, and in today's environment, it would be a continued deregulation to the point of not policy that's designed to improve productivity and economic activity, but oversight, which led to the potential abuse of power, combined with interest rates coming down substantially, combined with massive asset value appreciation of some unwarranted quantum computing. Maybe could be one of these things.
It could be.
So there's always this combination of factors. So interesting, but I'm glad we do have a tool to trade that if we needed to, and more importantly, as part of your retirement plan, the most critical strategy, the best thing that you can simply do to avoid those type of calamitous events that potentially and ultimately will happen again, is to not take more risk. This is to have congruence in who you are, the willingness you have to take risk and to stick with your investment plan versus the risk that you actually have in your portfolio. This is what asset allocation is all about. So very important reminder there that it's not necessarily about how you or where you invest or the tools or strategies that you use, but it's about how you deploy that capital, just like we spoke earlier in regards to a CFO. You're the CFO of your household. So deploying that capital intelligently according to your willingness to stay committed to that investment strategy within a framework that should not see your portfolio decline beyond a level that you are comfortable sticking to. So that's actually step one of the retirement success plan. So if that's of any interest, again, feel free to reach out to us. If you are a client, feel confident that we have done that for you already. And with that, we thank everyone for tuning in tonight to tonight's live stream. We've had a tremendous time discussing the impact of the One Big Beautiful Bill on the market, your portfolio, and we hope you enjoyed it as well. We will see you next month for Oak Harvest Financial Group live stream that I believe we're going to get into financial planning. So maybe a combo, financial planning and investments. That would be great. Thank you guys very much and have a good evening. We will see you next month.